It's a make-or-break weekend for Greece as yet another round of debt talks are scheduled. Jasper Lawler joins me. He's a market analyst at CMC Markets. Jasper, you believe the markets are actually relatively calm about this upcoming deadline next week, even if a deal is not reached. Why do you think that?
That's right. Markets are relatively sanguine. We're seeing European markets mostly higher today on Friday. And I think that just reflects two things, really. One is still a general belief that a deal can get done at the 11th hour, that perhaps creditors are just trying to push Greece for all they can to get as close as they can to just the original agreement that Greece tied up to before the new government came in. And then secondly, if Greece does miss this payment, a deal doesn't get done, it may be slightly different to, say, for example, they missed a payment to private bondholders. That's an automatic default. In this case, it's the IMF. Officially, Greece would fall into arrears, but that doesn't necessarily mean that there's going to be a mass run on the banks in Greece. And then even if there was a mass run on the banks, we do have the ELA program, which the ECB has been instituting recently. And so that, in theory, could add liquidity to the Greek banking system and prevent that. And then also you've got to consider the fact that we've had 5 months of this. And so there's good evidence now to suggest that a lot of the other European banks in different countries have slightly moved away from their correlations to Greek banks. So were Greek banks were to get into real trouble, that sort of spill-out effect into the rest of Europe would be a bit more contained.
Jasper, you also make a point, and this has gotten a bit lost in all this talk about Greece, that equities still have this floor under them because of what the ECB has done.
Well, absolutely. I think that really does kind of underscore where we are in equity markets at the moment, is that we do have this massive central bank stimulus behind us in Europe, and that obviously caused massive gains in equities in the early part of the year. But at the moment, there just isn't quite that stimulus needed to move on and make new highs, and Greece is a large part of that. We kind of need to get through this current Greek crisis, either with a fudge agreement that just puts us 6 months in time, doing another agreement, or something a bit more long-lasting. But one of the two is needed to continue pushing equity markets higher.
Jasper, how do traders and short-term players in the market hedge this over the next couple of days? Do you reduce equity exposure at all? Do you move out of fixed income or something else?
Well, I think as we've seen that the potential downside in equities from this is fairly limited, so I don't necessarily think there is any massive need for a hedge on that front. What's been one of the more interesting moves in the markets is with the euro. We've been flat for the last few days, but obviously the European currency is kind of what's at question here. We're facing at the extreme scenario a breakup of the euro. So you would imagine that that would be something that would come under serious selling pressure every time that there's some signs that maybe this deal isn't going to go through. What we've seen actually is the opposite. The euro has actually tended to rebound a little bit on signs that there are no default and gone down. It's really doing the opposite of what you would initially imagine. So the thought there is that actually it's a funding currency at the moment because of the low interest rates and the monetary policy of the European Central Bank. So actually people want to sell those euros when there seems like it's going to be a bit more stable, when the crisis is averted, so that they can invest into higher yielding currencies.
Jasper Lawler of CMC Markets, thanks so much for your time. Appreciate it.
Thank you.
I'm Rhonda Schaffler for The Street.